But right now, very proud to introduce for the first time, well, technically the second time because you were on the last segment, but for the first time on air with us in the iHeart Providence studios is Dave Koohy with Coastal Financial Group and Island Tax Associates. Now, Dave is a CPA.
Correction. EA. I'm an enrolled agent.
Oh.
Unlike a CPA, we actually also, like most CPAs, we get to go argue cases against the IRS in front of the court system.
Oh.
So not only can we do your taxes for you, but we can go argue them for your advantage. We work for you, the tax person.
Let's talk about how to stay out of IRS's crosshair.
It's one of my favorite subjects out there to begin working with. And being this is my first show here, a great way to kick things off. One of the things I do want to tell you, though, is this is often like I've often referred to a lot of my clients, lie to your wife. Lie to your husband. Lie to your kids. Never lie to your tax guy. He's the guy that's going to be there, or gal, that's going to be able to there and take care of and fix any of those fun problems that pop up. And not so much in April, but usually in July and August when you get those nice little letters in the mail. So right off the bat, that's one of the things you want to do. Be honest with him. Be upfront with him or her. Make it happen. Another thing I also see out there, to try to stay out of the crosshairs of the IRS, ladies and gentlemen, you might be a sole proprietor, an LLC, an S Corp, C Corp, along those lines. One of the biggest mistakes I see a lot of people doing is, and you try to do this because you want to minimize your taxes, minimize your tax liability. So unlike an S Corp or C Corp, where it has the officers, and you put down zero because you don't pay yourself then throughout the year because you take it all at the end of the year. The IRS actually sees that as a flaw because how are you surviving if you're not paying yourself or giving yourself a paycheck each week? And that's what the S Corps are for. Since it's a flow through, the C Corp's the same way. You're supposed to be receiving a paycheck. If you're a simple Schedule C, keeping it very simple, that one you could take a drawer on and not a major deal because at the end of the year, that's when you're reporting all your profit on your tax return. So they say you take an owner's draw throughout the year, and that's where that works then in your advantage. But let me just also give you some hints. You've got a big company, huge company, or even a small little real estate company that you're working with. Some of the things that I've often recommended to people in following, I'm going to use a real estate agent and a plumber. The IRS would look at a real estate agent and say he does not have much he has to go out and buy as far as raw materials concerned.
Right. Yep.
Okay. Like a plumber would buy piping, clamps, and everything else. That's okay. Your real estate agent, though, on the flip side, he does a lot of entertaining. Meals, tickets to the stadium, taking people out for breakfast, lunch, entertaining your clients. What I often see, though, is a lot of times is you get that plumber out there that says, oh, yeah, I took my crew out here. I went here. Yeah, no, you didn't.
Meals and entertainment, the most favorite column for the IRS.
And it's one of the biggest ways that you guys get flagged. And it's really unbelievable. And it just goes down, you get flagged on that. Another issue is advertising. Okay. Now, they would expect a real estate agent to spend hundreds or thousands of dollars in advertisement along different lines. Now, your plumber or your carpenter, he or she might not do that, okay? But yet, I've always tried to pull them in and say, did you spend any money on Yellow Page advertising, or did you spend any money on flyers?
Yellow Pages?
Well, okay, so fine.
What is that?
So I'm dating myself minorly.
I've once heard of these things. Yellow Pages. It's what you sat on for the booster seat in the restaurant, right?
It's fire kindling.
So those are some things that we also look at. Subcontractors. Now, again, a real estate agent, and I might use you as an example.
Sure.
You've got a nice team here, people working, and you send out, or possibly they work with you, and you might send out 1099s to them.
Yeah, our brokerage does.
Right, your brokerage firm does that. Now, that's actually a deduction for you. A lot of people say, well, I'm just going to pay them here, I'm going to pay them there. It is so crucial, the fact that you get out your 1099s. And again, I'm talking to, a lot of the either sole proprietors or a lot of these small people that work with, that this is what they need. They need to get out, and they're like, oh, Dave, he's a friend of mine. I don't want to give him a 1099. He's going to pay taxes on it or whatever. It does. Yeah. It's like, I'm going to pay him under the table, that doesn't really fly well with the IRS, especially when you're reporting $200,000, $300,000, $400,000, $500,000, $600,000 worth of business income in a year. And now you're coming to me in March or April, and you're like, Dave, why do I owe the IRS $25,000? Why do I owe the IRS $30,000? You're not only going to owe that money, but when they come back and disallow some of the deductions that you applied or tried to apply for, now you're going to be penalized. You're going to be scrutinized for the next minimum 3 years on your tax return. These are some of the things that I try to work with you. I try to teach you to go around so you do not have to worry about those things. We actually, like I said, there are rules and guidelines that we like to follow. Does that mean that I'll never cross the line for anyone out there? I might bend a little bit. I might stretch a little bit, but I'm not going to break the rules because, again, I'm going to be representing you. And I can only be as good as the information that you give me up front and what I need to do to make you sound, and proficient. So in case there was ever a problem, you are okay. We don't have to worry. Yes, you're covered. You're taken care of.
You're out of the crosshairs.
Tell me about home office. Some people will write off a home office. Does that get flagged?
Some home offices do. Believe it or not, Mary, here's one that I love telling people about, and it is so true. People want to deduct home office, and then they also take off rent. You cannot double dip.
Wait a second. So, like, I've got an office at HomeSmart, but I've got a whole home office at my house as well.
One or the other.
One or the other. Mary is correct.
Why not both? If I have two locations,
Double dipping. Well, you see, the IRS looks at it this way. If the company or if you have another place to do business at.
Yeah, we have two places.
Not your house, though. Where do you customarily and regularly perform business? That's going to be their question to you.
Well, I normally at my clients' houses, so can I write their houses off?
Actually, no. Where's the price? I'm going to write this house off, that house off. Yeah, no. I tried that once. It doesn't work. But you need to have a primary residence, and so that's what they would allow. Now, if you did not have an office rent, then yes, you use your primary home. But it has to be a dedicated room with a dedicated entrance. It cannot be the kitchen table. It cannot be the living room, and
because I thought there was some pretty strict parameters, and I can see their point. If you're deducting property taxes and or mortgage interest, you can't continue to take on excess deductions. You're right.
So, well, can I just interject? I've got a question. Okay, our listeners might want to hear this too. So, all right, so I've got like a ranch, right? But the downstairs has two different ways in and out. Okay, I redid that entire lower level because it has a separate entrance, and there's a kitchenette in there. It's all office down there. It's like a branch for DiSpirito team. We also have one at HomeSmart in the AAA building as well, right? So so you're saying that downstairs isn't
not
deductible?
Technically, again, that's one of those gray areas that, again, I'd have to work with you and have to do some research on. But what you're telling me is you have an office at a different location where you can meet with your team and everything else. Now you have a home that you occasionally, right? Is it occasionally you meet with your staff or crew there? Or?
No, daily people can be in and out there. Yeah,
it can be.
Yeah.
Well, it's one of those instances that we would have to take a look at and see if that would fly. And I'm not saying that it would not, but it's right. Thank you, Mary. It's got to meet their guidelines. The guidelines that are there that are listed. Okay, is this business conducted here? Is business conducted there? And I do get that a lot with the IRS. When again, with a lot of real estate agents. Again, I'm going to throw another company out there like Realty One for whatever, Century 21. A lot of people say, well, I work out of my home, but if they give you a place that you have a desk, that's your location. That's where you're supposed to be working.
Okay.
So for individuals, because we talked about small biz self-employed, for individuals, what are some of the things that they stumble on that gets them caught up for tax purposes?
Huge things. Ladies and gentlemen out there, do not commingle your checkbook, meaning you need a personal and a business account. Everybody try, I'm going to save some money, just put them all together. No, it's one of the worst things you can do is when you commingle the accounts. That's a huge no-no because you do need to keep the two totally separate. Again, keep it nice and clean and neat, and the IRS is happy and they'll leave you alone. You'll stay out of those crosshairs.